Welcome to Moneymakers. In this video we'll explore the world of index funds. We'll learn about the basics of index funds, the benefits of investing in them, and how to become an expert at leveraging index funds for your investment portfolio. So, let's dive right in. Index funds are a type of investment fund designed to track the performance of a specific market index. A market index is a collection of stocks or other securities that represent a particular segment of the market. Some well-known market indices include the S&P 500, which tracks the performance of the 500 largest publicly traded companies in the United States, and the Nasdaq Composite, which tracks the performance of all companies listed on the Nasdaq Stock Exchange. By investing in an index fund, you are essentially investing in all the securities that make up the corresponding market index. This approach provides broad market exposure and allows investors to benefit from the overall performance of the market or a specific sector without having to pick individual stocks. So, why should you consider investing in index funds? Here are some key benefits. First, diversification. Index funds provide instant diversification as they invest in a wide range of stocks or other securities, which can help reduce investment risk. Second, low costs. Index funds are passively managed, meaning they do not require active management by a fund manager who selects individual stocks or bonds. This results in lower management fees and other costs compared to actively managed funds. Third, performance. Studies have shown that, over the long term, index funds often outperform actively managed funds due to their lower costs and the difficulty of consistently picking winning stocks. And finally, simplicity. Investing in index funds is straightforward and easy to understand, making it an excellent choice for novice investors or those who prefer a hands-off approach. Now that we know the benefits of index funds, let's discuss how you can become an expert at investing in them. Step 1. Research and select your index funds. Start by researching different index funds that track various market indices. Consider factors such as the index it tracks, expense ratio, historical performance, and size of the fund. Look for low-cost, well-established funds that track indices that align with your investment goals and risk tolerance. Step 2. Develop a long-term investment strategy. Index fund investing works best as a long-term strategy. Determine your investment goals, time horizon, and risk tolerance, and then create an investment plan that includes regular contributions to your chosen index funds. Step 3. Diversify your portfolio. While index funds provide diversification within a specific market segment, it's essential to diversify across different asset classes and geographical regions. Consider adding index funds that track international markets, bonds, or other asset classes to your portfolio. Step 4. Rebalance periodically. Over time, market fluctuations may cause your portfolio to deviate from your desired asset allocation. Periodically rebalance your portfolio by adjusting your investments to maintain your target allocation. Step 5. Stay the course. One of the keys to success with index fund investing is to stay disciplined and stick to your long-term plan. Avoid making hasty decisions based on market fluctuations or short-term trends, and focus on maintaining a well-diversified, low-cost portfolio. Index funds offer a simple, cost-effective way to invest in the stock market. Thanks for watching and don't forget to subscribe.